The Fed just cut rates by 25 basis points, and if you're pursuing FIRE, you're sitting on the biggest acceleration opportunity since 2020. But here's what most FIRE content won't tell you. The conventional wisdom about positioning for rate cuts will actually hurt your early retirement timeline. Everyone knows rate cuts help stocks and create refinancing opportunities. That's investing 101. What most people miss is how FIRE portfolios behave fundamentally differently during monetary easing cycles, and why the tactics that work for traditional retirement accounts can backfire spectacularly for early retirees. I've been testing this personally since pivoting from crypto to serious FIRE investing in 2022, generating consistent returns through multiple market cycles. Now, I know this doesn't give me the strongest credit for investing, but there are some lessons learned that I could share with you. Here's what I've learned. The more you actually deploy capital and track real performance, the more you realize that FIRE portfolio optimization requires completely different frameworks than conventional retirement advice. The September 17th cut signals the start of a cycle that could compress 3 to 5 years off your timeline. But only if you understand the 3 counterintuitive positioning strategies that separate sophisticated FIRE investors from the crowd. Plus, there's one mathematical reality about withdrawal rates that changes everything, and it's not what most calculators are telling you. Let's dive into the advanced playbook for this cycle. Here's where most FIRE investors get it backwards. When rates drop, the instinct is to extend bond duration to capture maximum price appreciation. But recent research reveals something that should flip your entire fixed income strategy. There's actually no correlation between bond yields and safe withdrawal rates for equity-heavy FIRE portfolios. The data is stunning. Historical analysis shows the worst withdrawal rate failures occurred when 10-year yields were 3.5 to 6%, not at historic lows. When yields approached 2%, realized safe withdrawal rates actually reached 7%, because equity performance dominated portfolio outcomes. This creates a tactical opportunity that most bond-focused strategies miss completely. Instead of chasing duration for price gains, sophisticated FIRE positioning targets the 3 to 7 year sweet spot that BlackRock identifies as optimal for rate cut cycles. You capture the rate sensitivity without the volatility that can destroy withdrawal sustainability during sequence risk periods. But here's the advanced move. Use this cycle to de-risk your bond allocation, not amplify it. International bonds become crucial because dollar weakness typically accompanies Fed easing when other central banks maintain restrictive policies. This gives you currency translation gains, plus geographic diversification of monetary policy risk. The real opportunity isn't in your bond allocation, though. It's in recognizing that this rate environment creates the perfect setup for aggressive equity positioning that most FIRE investors are too conservative to capture. Rate-cutting cycles create 3 distinct phases for equity performance, and your allocation strategy should evolve through each one. We're currently in phase 1, anticipatory easing, where non-recessionary cuts generate the highest returns. Historical data shows 20% plus average returns within 12 months during these cycles. Here's the sophisticated insight. FIRE portfolios can actually be more aggressive during rate cuts than traditional accounts because your withdrawal timeline creates different risk parameters. When you're planning 50-plus year horizons versus 20 to 30 years, temporary volatility becomes statistical noise, and you can capture more of the monetary policy tailwind. The tactical positioning requires understanding sector rotation patterns that most generic advice misses. Small cap growth, rates, and international equities lead during early cutting cycles. Then rotation shifts to large cap quality as the cycle matures. REITs specifically offer the best risk-adjusted opportunity right now. They've underperformed by 55 percentage points since 2022, but gained 16% since May versus SPY's 1%. Advanced FIRE investors should target 60 to 80% equities depending on their specific phase, with 40% international exposure to capture currency benefits. This is significantly more aggressive than traditional retirement allocation, but the mathematics support higher equity weightings when you have flexible withdrawal capabilities. Which brings us to the counterintuitive withdrawal strategy that could actually increase your sustainable rate during this cycle. Here's the mathematical reality that changes everything. The traditional 4% rule wasn't killed by rate cuts. It was already dead. Vanguard research shows success rates dropped from 96% to 36% for 50-year periods. But this decline started before the current rate cycle. The breakthrough insight comes from Morningstar's guardrails methodology. Dynamic withdrawal strategies can increase sustainable rates to 5.1% during favorable market conditions, while maintaining 90% plus success rates. Instead of fighting market cycles, you surf them. Here's how it works in practice. Your baseline becomes 3.25 to 3.5%, but during strong performance years like rate cut cycles typically produce, you can withdraw up to 5.5% without compromising long-term sustainability. This flexibility actually increases your total lifetime withdrawals compared to rigid 4% approaches. The advanced implementation requires understanding that withdrawal rates and market cycles are inversely correlated for equity-heavy portfolios. During the strongest market periods, which rate cuts often create, you can safely increase withdrawals because sequence risk diminishes when portfolios are gaining value. But there's a tactical timing element that most dynamic strategies miss. The optimal withdrawal increase happens 6 to 12 months into rate-cutting cycles, not immediately. This lag allows you to confirm the cycle type and avoid false signals from single rate cuts that get reversed. The most immediate acceleration comes from treating refinancing as a portfolio optimization tool, not just a cost reduction strategy. Advanced FIRE positioning uses rate drops to unlock leverage strategies that dramatically compress timelines. Here's the sophisticated approach. Instead of just refinancing for lower payments, consider cash-out refinancing to deploy additional capital into higher-yielding assets. With rates dropping towards 6%, you can access home equity at costs below many dividend yields and REIT distributions. The mathematics are compelling. A $750,000 refinance from 7.2% to 6.3% saves $6,000 annually, equivalent to $150,000 additional portfolio value at 4% withdrawal rates. But the advanced play is using cash-out refinancing to access another $200,000 in equity at 6% to deploy into REITs yielding 6 to 8%, creating positive carry while maintaining real estate exposure. This leveraged approach particularly benefits accumulation phase FIRE investors, who can handle additional risk for timeline compression. The key insight is that mortgage debt becomes increasingly attractive relative to portfolio returns as monetary policy becomes more accommodative. The sophisticated FIRE playbook for this rate cycle centers on 3 tactical shifts: intermediate duration positioning in fixed income, aggressive equity allocation with international and REIT overweighting, and leveraged refinancing strategies that treat real estate as a portfolio optimization tool rather than just shelter. The withdrawal rate revolution means dynamic strategies can actually increase your sustainable spending during favorable cycles while maintaining long-term portfolio integrity. The 4% rule was already broken. Rate cuts just made better alternatives more obvious. Here's your advanced insight. The biggest opportunity isn't in chasing yield or playing duration games. It's in recognizing that FIRE portfolios have fundamentally different risk parameters that allow more aggressive positioning during monetary easing cycles. The investors who understand this distinction and position accordingly will compress years off their timelines, while others debate whether 4.5% savings accounts are better than 4% savings accounts. Rate cuts don't just help FIRE portfolios, they accelerate them for those sophisticated enough to optimize the opportunity.